We released the report last week. I'm going to show a few slides today to give a kind of a big picture idea what we try to achieve in the report. The report has the usual global outlook and regional outlooks. The regions we are, of course, focusing on at the World Bank and mainly emerging market and developing economies. In addition, there are two analytical chapters in this edition of Global Economic Prospects. The first one looks at investment growth in emerging market developing economies and how weak it has been over the past 2 decades, especially after the pandemic. And then the second chapter looks at the challenges confronting small states, those countries, population 1.5 million and less. And of course, a number of these small states are in the Pacific, small island nations. What I'm going to do, I'm going to focus on 3 questions. The first one, what are near-term prospects for the global economy? The second one, how have overlapping global crises affected small states? And the third one, what are the policy priorities? Throughout the presentation, I'm going to use this acronym, EMDES, that stands for Emerging Market and Developing Economies. Let me start with the first question. What are near-term prospects for the global economy? Over the past 12 months, global economy has been buffeted with a wide range of shocks. The first shock, of course, the legacies of the pandemic and how that has been affecting quantities in terms of production and as well as prices. The second one is the elevated inflation and a sharp increase in interest rates. The third one, of course, the volatility in commodity markets, and that volatility is associated with in part with the Russian invasion of Ukraine. Against this background, we downgraded our growth forecast significantly for 2023. We are now expecting growth this year to be around 1.7%. This is 1.3 percentage points lower than what we expected in June. It's important to put this number in historical context. It is the third lowest growth rate since the early 1990s. The other two numbers, lower than this one, were associated with the 2009 global recession and 2020 global recession. In other words, the global economy is on a razor's edge, perilously close to falling into a recession. If any of these shocks we are going to discuss soon, the risks materializes, there is a high likelihood that we will see a global recession this year. We also downgraded growth forecasts in advanced economies significantly. Last year, these economies delivered growth around 2.5%. This year, that number will decline to 0.5%. And that's one of the lowest growth rates advanced economies delivering over the past 4 decades. Now, in the context of emerging market developing economies, growth, at least in the aggregate, appears to be stable, 3.4%, basically the same number we had last year. But this is entirely due to China's performance. We believe that China's growth is going to increase this year around 4.3% than what it delivered last year, slightly below 3%. But in the rest of emerging market developing economy group, when you take out China, growth is going to slow significantly from 3.8% to 2.7%. This is a very low number for these economies, even lower than the pre-pandemic average we saw, slightly above 3%, which we thought was quite weak. When you look at the regions, in all regions, growth forecasts were downgraded for this year. East Asia Pacific is going to deliver higher growth thanks to China's performance. I'm not going to get into the details of that one, as we have a presentation dedicated to China and the broader region. When you look at Europe and Central Asia, where the war takes place, growth is pretty much flat, around zero. If you take out Russia and Ukraine from the broader group average, aggregate, the growth slows down significantly. Sub-Saharan Africa will see slightly higher growth, but that's not going to be sufficient enough to cope with the challenges the region is facing. Now, I mentioned one of the analytical chapters in the edition of Global Economic Prospects report looks at investment in emerging market developing economies. Investment is central to delivering higher growth. Of course, growth is central to reduce inequality, reduce poverty, and make progress in broader development goals, including improving health and education systems. Prior to the pandemic, we already had a significant slowdown in investment growth, as you see on the left chart. It doesn't matter what group of countries you are looking at. It doesn't matter whether you basically include China or exclude China in the sample. Growth of investment declined significantly. It was around 10% over the period from 2001 to 2010, then declined around 5% over 2011 to 19. Then the pandemic came. About 70% emerging market developing economies experienced outright contraction in investment. Since then, investment has been recovering, but recovering very slowly. In fact, as you see in the middle panel, investment recovery has been much slower than what it took place after the global financial crisis. Our calculations suggest that cumulative investment expansion since 2020 over the forecast horizon up to 2024 would be around 15%. Over the same time period, from 2010 to 14, investment growth was around 50%. So going forward, we are expecting even weaker recovery in investment in emerging market developing economies, as well as if you look at emerging market developing economies excluding China. And this will basically magnify the types of development challenges we have. During the previous decade, emerging market developing economies enjoy a protracted period of friendly financing conditions. In the 2020s, for the rest of this decade, those financing conditions are not going to be with them. So generating investment is going to be even more difficult when they face larger borrowing costs, of course, the challenge of generating growth. This somber baseline comes with a wide range of risks, and these risks are interconnected. And the number one risk, inflation, is remaining persistent. We think that inflation will come down this year. Last year, we saw inflation around 7.6% globally. This year, that number will go down to 5.2%. But core inflation, inflation that excludes food and oil, energy prices, will likely remain elevated. And elevated enough, central bankers, especially in advanced economies, will continue increasing interest rates or keep interest rates elevated. With persistent inflation and elevated policy interest rates, financing conditions will remain tight, in all likelihood will get tighter. And that increases the likelihood of financial stress in an environment we have record high debt levels in many emerging market developing countries, especially in frontier markets and low-income countries. Another important risk we are monitoring is geopolitical tensions. Those tensions now have a history. Of course, that history has multiple dimensions in the context of trade. Now, the Russian invasion of Ukraine and the war-related tensions. Those tensions manifest themselves in highly volatile commodity prices and bring energy and food insecurity in advanced economies as well as in emerging market developing economies. When you have high inflation, when you have weak growth, when you have food insecurity, the likelihood of social tensions increases. COVID-19 outbreaks remain a risk, as we see now China is dealing with an outbreak, and hopefully it will overcome this outbreak sooner than later. In addition to these risks, we have risks associated with climate-related disasters, fragmentation of global trade, investment and financial networks, and over the medium and long run, weaker longer-term growth prospects and even larger development challenges. As I mentioned, the number one risk is the risk of persistent inflation. Inflation can come down, but can be sticky at a level higher than central banks' inflation targets. If that happens, central banks might have no choice but to increase interest rates even further. Nowadays, global policy interest rates are around 5%. In the report, we look at different scenarios, analyzing the consequences of further increases in policy interest rates. In one of these scenarios, we look at the possibility of interest rates going up to 6%, another 100 basis points higher than their current levels. If that happens, real short-term interest rates go above 1%. And of course, the real short-term policy interest rates have been negative for an extended period of time. And it will be the first time after this protracted period of accommodating financial conditions, we see positive real rates. If that happens, there will be a serious collapse in confidence, heightened financial stress, and weaker growth. Growth will go down around 0.6%. Per capita global growth will be around minus 0.3%. And that will mean a technical global recession. Now, as I mentioned, this is not our baseline. In the baseline, we see weaker growth, but at the same time, slowing inflation. What are these multiple global shocks implying for income and income of the poorest? Over the forecast horizon we have till 2024, given that we have first 3 years of the 2020s, 2020, 21, 22, we are able to look at the growth performance of the first half of 2020s and compare it with the previous decade. That comparison leads to a disappointing outcome. The first decade of 2020s will, in all likelihood, witness per capita income growth in all regions we monitor, lower than the average per capita income growth of the decade prior to the pandemic. And over the next 2 years, the income growth of countries with higher levels of poverty will be lower than those with lower levels of poverty. In other words, we will have greater difficulties in terms of convergence of emerging market developing economies to income levels of advanced countries, and we will see weaker growth in countries that need the growth the most. Let me turn to the second question. How have overlapping global crises affected small states? Now, as I mentioned at the beginning of the presentation, small states are those countries that have population 1.5 million and less. We are looking at 37 small states in this report. These are middle-income countries, emerging market developing economies. There are a number of common features of small states, as much as the group of small states is quite heterogeneous. These common features make them extremely vulnerable to a wide range of shocks. And these shocks, in fact, hit them during the past 3 years and have the largest impact on this group of countries. The first common feature of small states is how open they are to trade when you compare them with emerging market developing economies, excluding this group. The second common feature is how much they rely on other countries for their food and fuel consumption. Of course, this specific feature made them quite vulnerable to consequences of the war in Ukraine. Many of these small states, especially those in Caribbean and the Pacific, are small island states. They rely on tourism revenues much more than a typical emerging market developing economy. During the pandemic, tourism collapsed, and the revenues of course, tourism collapsed as well. That was a big shock for small states. Another important feature of these countries, they are geographically remote, especially those in the Pacific, than from centers of commerce. So when you put all of these common features and vulnerabilities, something remarkable happened over the past 3 years. During the pandemic, these economies were hit hard. They contracted more than 11%, 7 times larger contraction than typical emerging market developing economy. Since then, recovery has been very slow. As financing conditions have gotten tighter, these economies, that problem also became a bigger burden to carry. Of course, during the pandemic, they needed to borrow more to close the holes, and they even added a larger stock to the existing stock of debt. Now, for the first time this year, we are expecting small states to get back to pre-pandemic level of GDP. This happened in the first year after the pandemic in emerging market developing economies. So the challenges small states are facing quite sizable. They are like canaries in the coal mine. They tell us the magnitude of the impact of these overlapping crises and what can happen next when, of course, other types of crises hit. One of the important vulnerabilities of the small states is their sensitivity to climate-related disasters. Now, when you look at the policy priorities and the structural challenges emerging market developing economies facing, there is a large cost of climate-related natural disasters. This large cost manifests itself very visibly in the case of small states. For example, Caribbean small states paid around 6% of their GDP when they faced these types of natural disasters over the past 4 decades. Now, of course, this challenge associated with natural disasters, given the limited capacity of these countries, magnified, since they are unable to simply respond to these types of frequent and costly shocks. Prior to the pandemic, food insecurity was a problem. And when you look at low-income countries, give and take around 50 million people were suffering from food insecurity. Now, last year, that number went up to 110 million, just in low-income countries. Many of these low-income countries are fragile conflict states. But the magnitude of the problem requires serious and bold intervention. During the pandemic, another big problem became even larger. Prior to the pandemic, we thought that there was a learning crisis. that learning crisis intensified with the school closures and ability of the kids to acquire the type of education they typically acquire. Now, what countries can do in an environment with limited policy space? Every crisis presents an opportunity. In the context of this crisis, finding ways to facilitate trade, reduce the cost of trade across borders, improve customs and regulations, and digitize the types of factors that impede trade going to be critical. I mentioned investment weakness. There is a wide range of reforms countries can undertake to improve investment climates, improving institutions, improving private property rights, improving legal systems, improving overall business climates to attract more foreign direct investment and providing incentives to local entrepreneurs. Countries, they deliver these types of sustained investment reforms, so significant increase in investment. And those countries, they ended up seeing setbacks when it comes to investment climates, suffered larger declines in investment. Another important reform agenda should be on domestic revenue mobilization. Revenue collection, as much as it has increased over the past 2 decades, still remains lower relative to GDP in emerging market developing economies and low-income countries. This is another important reform agenda for them to push in an environment fiscal space remains limited. Now, when we think about policy priorities, there are certain policy challenges we need to address at the global level. Of course, that starts with mitigating the risk of global recession by implementing transparent, consistent, and credible policies. There is a very serious debt problem, especially in frontier markets and low-income countries. We need to have a better, faster, more robust framework to address the debt challenges these economies are facing. And of course, we need to coordinate better to reduce food insecurity. At the national level, we need to avoid protectionist measures. They are not helping, they are hurting, and they are magnifying the problem as they increase the cost of food at the global level. Climate challenge remains a major issue, and there is greater recognition now to address this problem with larger resources by the global community, and we need to intensify that reform agenda in the context of climate and find those resources, channel those resources, and push infrastructure projects on the ground to address the climate challenge. Now, at the national level, everything starts with policymakers taking care of their houses and making sure that their houses are in order, meaning domestic policy agenda set on strong foundations to address weaker investment growth and basically improve policy frameworks in the context of fiscal policy, in the context of monetary policy, and in the context of financial policies. I mentioned small states. There are interventions these small states can undertake, as well as interventions at the global level international community has to push through. Small states can push diversification through digitalization, reducing trade costs, and fostering new industries, including ecotourism, investing climate adaptation, and domestic renewable energy sources going to be critical for small states. State-owned enterprises will require more discipline, and establishing fiscal mechanism, fiscal rules, disaster stabilization funds to enhance disaster risk management going to be critical. At the global level, there has to be larger resources allocated to address the challenges confronting small states, especially in the context of climate change. Let me summarize what I said. First question I asked, what are near-term prospects for the global economy? We are going to see the weakest growth performance outside global recessions of the past 3 decades. There is a serious investment slowdown, and that slowdown is coming on the heels of a decade of subdued investment in the 2010s. And multiple downside risks cloud the outlook. Second question, how have overlapping global crises affected small states? These economies suffered a far more severe recession during the pandemic and now experiencing a much weaker recovery than other emerging market developing economies. And the third question, what are the policy priorities? At the global level, we need to cooperate to address universal challenges we are facing, including climate change, food insecurity, and debt distress. At the national level, we need to implement credible policies to contain inflation, ensure macroeconomic and financial stability, and set the foundations for a green, resilient, and inclusive development path. Let me invite all of you to visit our webpage to check other publications on global macroeconomic challenges. Thank you, and back to you, Mike.